Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And today we are talking about a very novel solution for generating retirement and income in Canada. Okay, so we're going to have a lot of interesting questions here today. But before I jump in, I want to introduce our audience to Tisa Rabun-Marshall, who's joining us as a host. Tisa, can you tell people just a little bit about yourself?
Sure. Thanks, Paul. So I have about 20 years experience in the industry, and I currently am working to manage the digital platforms and tools for our retirees and our agents here at NASA.
Yeah. So anyway, welcome. Thanks for getting behind the mic. This is great. Bruno, tell us what's up, and who did you get for us to come on the show today?
Sure, it'll be my pleasure to introduce you to Fraser Stark, who's the president and of Longevity Retirement Platform at Purpose here in Toronto, Ontario, Canada. Fraser has a very interesting background. Obviously, extremely focused on the financial services, but not just on the financial services. But nevertheless, we're very excited and very pleased. And Fraser, welcome.
Yeah, thanks for having me on. It's great to be here.
All right. So my first question is obviously is in terms of lifetime income solutions, we have major academic bodies that have support this, that have written about it. Many entrepreneurs, including myself, have tried to bring this type of solution, and you guys are the first ones to do it, over the entire world. How did you do it? That's my question. How in this world, were you able to successfully launch this venture?
Yeah, maybe maybe you could, Fraser, just tell us what it is. That would be great. And then
why don't I start with what it is and then how we did it? That sounds excellent. So the Longevity Pension Fund is the world's first longevity risk pooling in a mutual fund. So this is not a new concept. This idea of variable lifetime income is not new. It's existed in Europe as tontines for many years. Canada has been experimenting with this for decades. Australia more recently. There's lots of iterations of it, but we found a way to offer investors income for life in a way that their assets are still invested in the market and they're benefiting from market returns, and yet they're risk pooling with the other investors. So we think it's a great product that fits alongside annuities as part of the possible offering for someone in retirement looking to solve that nastiest, hardest problem in finance, which is how do you decumulate assets when there's so much uncertainty, including most notably that idea that there's a huge range of possibilities for how long you need the assets to last for. Now, the way we did that as an asset manager is we looked at the mutual fund structure in Canada. It's a little bit different than the US, but by and large, it's quite similar. And we said, how would you have to tweak a mutual fund to embed longevity risk pooling into this structure? And that's exactly what we did and launched last June.
So you're not an insurance company,
correct? That's important.
Okay, but you're pooling mortality. And what is different? And again, we have a lot of listeners in the U.S. What's the difference between what you're doing and say, oh, I've heard it before, Paul, it's a target date fund?
Yeah, of course. A target date fund is a great product for mixing the risk and return profile of an investor as they move through different life stages towards retirement. And so, target date funds serve that purpose very effectively. What they don't do, though, is once someone enters retirement, they don't provide risk pooling. That idea that, we like to say our assets are worth more to us, or a portion of our assets are worth more to us while we're alive than after we've passed away. And so what our product inherently does is it creates a trade-off for people between the estate for whatever assets are put into this fund and optimizing for sustainable income while you're alive. So a target date fund is a great product. And in fact, I think an investor might very well use target date funds and then at retirement, put money into the longevity pension fund to secure against that risk that they end up being someone who lives to be 104 or 96 or 110. We just don't know. And effectively, investors or retirees investing who hold a balanced portfolio, almost no matter what the construction is, in some ways they're self-insured against their own longevity risk, that idea of living a long life. And we've given them a way to, effectively get a type of pension. It's not a registered pension in Canada, but we use the word pension in the title because it is that income for life. And all of our actuarial modeling shows that while it's variable and can go up or down with market conditions and the experienced mortality of the investor pool, it will always pay income for life. And so people can rest assured that they're spending more now or drawing more income from their allocation to this fund, and yet there's no chance that it runs out of money, which is a real possibility if someone starts with $1 million and spends $70,000, $80,000 a year. There's a chance that if you live into your 90s or past 100, you could run it.
That's great. Can you talk a little bit about that structure? How does it work when and discuss maybe a few scenarios, a few triggers. If I put in, as I said, some funds, we all agree that there's no one size fits all solution, but part of any retiree's funds, let's say $100,000 at age 65, what happens under various scenarios?
Yeah. So essentially the key difference between this fund and most other income funds or balanced funds is that it's redeemed not for its NAV, but rather for the lesser of its NAV or unpaid capital. So unpaid capital is the amount put in at 65 less the distributions received to date. And so, an investor who puts in $100,000, as you said, Bruno, and then let's say over 3 years they receive 20,000 back. And then if they either pass away or voluntarily just say, I'd like to redeem these units, and that's a key benefit to this fund is the redeemability, they would get back the $80,000, right? Not, let's just say the NAV had gone from 100,000 and because it's paying out income, the NAV is now at 93. They wouldn't get 93, they'd get 80. And the 13,000 difference between 93 and 80, that's the longevity credits that flow in and stay in for the benefit of the remaining members of their cohort. And we construct our cohorts on 3 birth years. So our oldest cohort that we have investors from is 1945 to 47. That's cohort 1. Cohort 2 is 1948 to 50, and so on through people that are 65 today, who I believe are born in 1957. And every 3 years, we add a new cohort as people in another block of 3 birth years start turning 65. But that's the risk pooling, right? So unlike an annuity, which sits on an insurance company's balance sheet, and they basically say, we'll take this risk. We'll take your personal longevity risk, and we'll take the market risk, and we'll guarantee you. And there's obviously a huge variety of annuity structures. Can't address them all today. But under that structure, the insurance company is accepting both market risk and longevity risk. With the longevity pension fund, we as an asset manager are taking on neither. What's happening is the longevity risk is being pooled among the investors in the pool based on that birth year set. And the market risk stays with them. We've got a portfolio construction that's very conservative, designed suitable for someone in retirement, but the market risk stays with them, which means it's variable. It also means they benefit from the market risk premium and just the fact that market returns are expected to be higher than risk-free interest rates. And as I said, they pool that mortality risk. So it's a great product for someone who says, I'm comfortable with some variability in my payments in return for more flexibility, a higher starting rate, and the expectation and design that this should rise over time. So we've done a ton of modeling. We work with LifeWorks actuarial team on the modeling. And under a wide range of economic scenarios, you can see that in most cases, but not all cases, and that's important, this fund raises its distributions over time. But an investor in some of the downside scenarios, an investor who's in a traditional balanced portfolio, they're going to see that portfolio decline as well. And they're probably going to have to make some spending reductions. And a very similar thing is likely to happen with our investors in a downside economic scenario.
I found that cohort concept really interesting. I read the footnotes, your marketing brochure. T is laughing because this is what we live for, footnotes in these products. So, I'm born between, this year and that year, but it's now 2027. Is there any point at which I can't join that cohort?
Yeah, any investor is eligible to invest in the fund until their 80th birthday. The day you turn 80, you're no longer eligible. And that's because of the evolving nature of the longevity expectations and visibility into it. We didn't want a situation where someone could join a cohort at 91, knowing that they're in good health. And many of the people that committed to that cohort much earlier perhaps are now in different states of health and life expectancy. So anyone up to the day before they turn 80 is eligible. Most people are investing much earlier in their late 60s. We also have an accumulation class of this fund. So until someone's 65, they can invest in the fund. The risk pooling doesn't yet apply. So it is redeemable at NAV, making it behave much more like a traditional balanced fund. It doesn't pay income. It's going to grow the assets with market returns. But so people are... Yeah. Sorry, Paul, go ahead.
Oh, no, I'm just curious. So these are almost like bottles of wine you're collecting, right? Except the flask
we
is
get better
not,
as we age. That's right.
Yeah, they're better as we age. But is there so much transparency that I could, if I'm going into that fund, I could say, God, my group, Fraser got a lot of sick people. This is a good deal. I'm healthy. I run marathons, and I think I'm going to outlast that group. Is that something you can, policyholders, or the wrong terminology, but will investors be able to do that?
Well, they won't know who the other people in the pool are. And that's important for privacy reasons. If you think of the tontine structure, much maligned, there's this idea, and I think The Simpsons popularized this a number of years ago, this idea of incentive to take out your fellow members. And I mean, that's sort of a comical approach. But for obvious reasons, the investors in the fund are not that's not public to investors. You asked about transparency. We are fully transparent with how the portfolio is invested, how many investors are in someone's cohort. We track and annually issue a report. We're not required to as a mutual fund, but we want to take on as much of the apparatus of a pension as possible. And so we're about to publish an annual report that will give the unit holders, the investors, a great deal of information about what's going on. Paul, I think what you're asking about, though, is this idea of adverse selection or selection bias, which is a really interesting concept here. Anytime you've got a group of people that are opting into something, they may behave somewhat differently than a group of people that were selected at random. And so there's a couple of ways that can play out. One is, is it only the joggers, so to speak, who join this, or people who know that their parents both lived, well into their 90s, for example. That's one type of selection bias. We are assuming we'll see some degree of that. We've done a lot of research into the degree to which people's perceptions of their own longevity align to what actually plays out. And the answer is it's neither perfectly true nor perfectly false. It falls in between, that people have some degree of a sense. Another type of adverse selection, for people that want to play Moneyball here with the fund, is around birth years, right? And so someone who was born in, December 1947 is a year and a half younger than the average and 3 years younger than someone that was born on January 1st, 1945. And so that's something we are able to watch for early, and we're not yet seeing any clustering of investors by birth year. We suspected we might see people skewing to the younger side. It's not. The average of our investors falls squarely on that midpoint of the cohort's birth range. So it'll be a long time for this fund before we have visibility into, is there adverse selection happening on that health or longevity? We've assumed there will be some. It's modeled in. And we've also done a lot of pressure testing of our model to say, what if we're off by a year? What if we're off by 2 years? What if we're off by 4 years? I mean, a 4-year extension of mortality on a group of thousands of retired investors is, that is a real test. And what it shows is the fund still accomplishes its goal. It still pays income for life. It still rises, but of course, by definition, it would rise less steeply in the scenario where they live longer. And that's just because there's more payments to make through the life of the fund.
That's a very interesting segue to the strategy of the structure. I mean, I think it starts at a fairly low level. As you mentioned, the mortality and the investment risk is on the participants' shoulders, but at the same time, you do structure it in a way that payments go up over time. You could have structured it in a different way. Can you talk a little bit about that strategy and the mentality behind that structure?
Yeah, we really wanted to be able to tell investors that while it's variable, and it's important that investors know that, right? Education is a key element here to selling and marketing this fund responsibly. But we wanted it to rise over time. And what we've created is a fund that in our modeled scenarios, I believe the average is about 5 or 5.5% market returns with a lot of annual deviation from that. And in the average scenario of these 2,000 that we've modeled, the fund increases its distributions on average 2% a year, which right now doesn't sound a lot like inflation levels. But if we rewind 6 months and think about long-term targets that central banks set, what it means is this fund is designed to keep its payments up approximately with long-term targets. It's not indexed the way you can formally and firmly index an annuity, but it is designed to raise payments with inflation and with market returns over time. When we set the initial distribution level for the fund, so the retirement age cohort started at 6.15%. Cohort 4, people born 1954 to 56 when we launched, was people about 65 to 67 years old. We started that at 6.15%. One of the decisions we had to make at launch was, do we start with a number like that that's lower and expected to rise and be transparent about that in the fund's prospectus? Or do we start with a number that's higher and sort of has an equal chance of increasing or decreasing as the fund moves forward? And we deliberately chose the former, to start lower. What that meant is that when we think about this like a defined benefit pension, and we think about the funding level, the fund started with approximately 20% overfunding. So it was in a 20% overfunded position if you compared, the assets in the fund with the present value of all future liabilities. And, it's not been the year that any of us in financial markets wanted to see, but I think it's been a year that's really validated that strategy, because going into 2023, we're in the process with our annual report of defining what are the distribution rates. And I think a lot of people are expecting that we may have to cut those rates. We said it was a variable fund, and in years when markets don't do well, there will be a decrease. But because we deliberately went in with that buffer, we've used a good deal of that buffer across the 5 cohorts. It differs by cohort, but all cohorts are going to be holding their distribution level steady, which I think is really powerful to an investor who's put money into this fund, knowing the goal is to create certainty so they can spend with confidence in retirement. And even though they acknowledge it's not an annuity with a guaranteed floor and a balance sheet of a major corporation backing it, it's really powerful that it's been able to hold. So that's some of our thinking around distribution levels.
Hey, Fraser, I'm going to jump in and ask you, how are you marketing this and selling this? How are you finding these cohorts or these members, investors, through agents, direct online? Tell us a little bit about the marketing.
Yeah, it's a great question. This is an investment product, and so it's sold where people buy other mutual funds, the accounts that they might use to buy stocks or ETFs. So it's sold through investment dealers in Canada. The fund's available to any Canadian. Some dealers have put this fund on their shelf and others haven't. One of the surprises we've seen is, it's been warmly accepted by people who think a lot about retirement and the challenges of it. Banks have taken, so far one of 2 paths, banks and other wealth dealers. Some have approved, some have not. It's a pretty novel concept, this idea of a fund that doesn't redeem at NAV, which, my assets aren't all mine. It's an interesting concept. So there's some of that. The decisioning that goes on around how much income to pay and the income policy that we've set working with LifeWorks, I think that some are still getting their head around that. But we do direct marketing to investors. And so there is a direct to investor marketing effort here where we've got digital ads, TV, radio, raising awareness for the product, driving education. A lot of our investors are do it yourself. They're buying this through an online account. It's sold as a mutual fund. It's not available as an ETF. And that's because it's not designed to be traded the way you can easily buy and sell an ETF. It's more of a product that though an investment product is meant to be bought and held for years, even though you've got the ability to redeem it days, weeks, months later, for our investors in the decumulation class post 65, it's better to not. So it's both through investors directly, it's through their wealth advisors, and we're seeing growing adoption by investment advisors in Canada. And then finally, it's now available as part of workplace programs. So any company that's running a DC, a defined contribution pension plan, where the employees at retirement can choose, different options. LifeWorks has added this to their platform on the platform side and consulting side. And so plan sponsors, companies in Canada that run their program through LifeWorks are able to turn this on. And so we're now, that went live last month, and we're now in discussion with plan sponsors who, they need to understand the fund, of course, and what it can mean for their employees. But what a phenomenal way for a company to show that they care about their employees' outcome, even after they're retired. It's not just saying, hey, you worked with us for 25 years, you've saved up a lot of money, here it is, let us know where you want to transfer it, and good luck figuring out how much to draw each year. It's, hey, you can stay in our plan, and you can have income for life in a non-guaranteed way, a way that's variable. But what that does that's so nice is it allows that income for life without the financial and fiduciary responsibility on the corporate balance sheet, which of course DB pensions have put on over the years, and is the main reason why most companies are moving away.
Yeah, and Fraser, you've got a real interesting background because you just came from Facebook. You worked with Influentive. What lessons did you learn there that you're applying into this space?
Yeah. The other part of my career, I started at Bain & Company as a consultant, and my clients were retail banks in both Canada and the U.S., wealth management firms, as well as one of the largest Canadian pensions. And so I've worked in the DB pension side. I've worked, so I do have a more financial background. After Bain, though, Influitive and Facebook, both tech companies, and both really innovative. And I think that's what's happening here is I was drawn to this role to join early 2021 because it's important innovation, and it's not going to be easy. This takes real change and mind shift, and we've got a product here that solves a really important problem for retirees, and yet it looks so different. That getting the product design right and thinking about it both in financial terms as well as consumer terms, and the real way that people make decisions at the kitchen table, talking to their advisor, talking to their spouse, talking to their kids, all of those things, it makes it a fascinating problem to solve, and it's been a ton of fun so far, and we can't wait to see where it goes. But this is what I do in my career. Is I think on my LinkedIn I say I like solving really challenging problems with technology, and this is more financial engineering than database engineering, but nonetheless, it's a really cool space, and I'm loving being here.
No doubt there, and then I mean that's going back to the point you mentioned earlier on education and that kitchen table sale. Can you discuss some of the initiatives that you've had, and what are some of the challenges that you've had in terms of bringing the idea, the concept forward to people, to individuals, or to employees, as you mentioned?
Yeah, there are a couple of challenges here. One thing is that I have found interesting, has been a bit of a surprise, is when you start talking about this fund, a lot of people, you see their mental wheels start turning, and they say, but if I put all my money into this, I'd be rather illiquid, and they're not wrong. But we sort of say, well, who said anything about putting all your money into this? I mean, that's sort of true of any product, is it's not right for everything. So that education, what I'm getting at there is sometimes we bring in our preconceived notions on products. And when you talk about a product like this, people jump to all of it. And we say, absolutely not. This isn't right for everyone. And even the people it's right for, it's not right for all of their assets. One thing we're seeing is a lot of our investors actually already have a DB pension, or they already have annuities in their portfolio. And what they're doing is they're compartmentalizing the income in retirement and saying there's a portion that's absolute baseline. In Canada, we have pretty good government supports, which is great. And some people buy annuities to create more, guaranteed income at a fixed level. This allows them to have income for life at a variable level. And we show them that it will vary, but it shouldn't dramatically because of the way we manage it. So that's one thing on the education side that's been really interesting. The other is just because this product looks and sounds like an annuity in some ways. A lot of people, we have people ask us, well, how can you say it's guaranteed? And we say, well, we didn't say it was guaranteed, right? We said it's income for life at a variable level, and that's clear. But they're bringing in that notion that because it's income for life, and the only income for life people have ever seen is a DB pension or an annuity, they're bringing that in as well. And the final example in that sphere is that it ties to a single person. There's no spousal component to it. That's an innovation we could do further. There's trade-offs to it. Of course, because a couple lives longer than a person, the distribution levels would be lower, and that could be the right trade-off. But a lot of times people say, well, my spouse and I, both need income, and I want, they feel as though the product is designed against their interests by not being spousal. And we have a conversation and point out, and generally we get them there that, well, you can buy some in each person's name. And in fact, that actually lets you create a very effective income flow before and after the first member of a couple has passed away. You can actually engineer it really brilliantly because, again, this allocation, let's say a couple with $1 million who put $400,000 into longevity, 200 in each person's name, they've created a very nicely aligned stream of income to their needs before and after the first member passes away. But these are what I'm getting at is that we carry a lot of preconceived notions in. I think financial education among the general population varies, right, from high to quite low. And it's important for everyone, to think through these issues. So I think the same issues that an agent would struggle with or might struggle with explaining a more complex annuity to a family, I think some of that exists here. But people are really resonating with this message of, still benefit from market returns, have the confidence to spend. It's still assets that you can think of in your portfolio because they are there for you. And when you pass away, a portion is left in, or after a number of years, it's all left in. But those are some of the challenges, Bruno, that we're facing.
Wonderful. And I know we kind of touched on it a little bit, but you mentioned some of those preconceived ideas, some of the guarantees. Any other parallel within with your comparable peers, and i.e. Annuities? And any other differences you'd like to highlight, and maybe perhaps on the investment side we didn't discuss too much, but and anything in that particular area?
Yeah, the investment side is it's our CIO at Purpose, Greg Taylor, who manages the portfolio with no one but. They've created a truly diversified portfolio across geography, sector, strategy. It's a mix of fixed income and equities. We use a hedging overlay to further reduce risk. There's about a 19% allocation to alternatives, which we invest in through liquid alternative funds, which gives access to real estate, to energy, to precious metals, base metals, et cetera. That portion of the portfolio has been really great this year when we've been so challenged in markets with this inflationary environment. The portfolio is targeting a return of only around 5%. It's deliberately seeking return with minimal volatility. This isn't about, a lot of DB pensions actually strive for 8 to 9% annually. They almost need to hit that over the long term in order to make make all their payments. But we've set this up to work on a low return basis. That said, it's very different than an annuity because it's an investment fund. There's no capital reserve requirements. We're able to benefit from that market risk premium, and I think that's really powerful. And as much as in these early days, there's a lot of education with investors going on that sometimes goes very well. Sometimes the product is still too foreign to people, and that's okay. But I see this over the long term getting to a place where it's much easier to explain than a lot of annuity constructions. And the transparency is powerful. When someone passes away, Purpose Investments does not benefit from that in any way, right? If you think about where those mortality credits go, it always flows to the pool. We receive a management fee, as investment managers do on every fund, that's taken annually as a percentage of the asset. But the residual left in the pool always benefits the surviving investors. And I think that's really powerful. People are funny about the concept of fairness, right? Things that don't really seem to affect us, we still care about a lot. And there's reams of psychological research into how important fairness is. And that's one of the elements that really resonates with investors when we speak to them, is that idea that a corporation is not benefiting, if they pass away early. The other huge difference from an annuity is really around that idea I touched on at the beginning, that an investor can choose to redeem this. And I think that's really powerful. Of course, many annuities will either keep paying or lump sum out to the estate of someone who passes away, but your voluntary redeemability is typically quite low, depending on the structure. With this fund, we never treat it any differently, whether you've passed away or are simply asking, to have your money back. And I think that's really powerful. It means no one ever has an incentive to live or to die. If you think about it financially, I think that's a powerful benefit.
Yeah, Fraser, I think we just lost Bruno, unfortunately.
Yeah.
But
Okay.
Tisa, I know you had a question.
Yeah, I wanted to jump in. So I agree with you, sort of that power of fairness and choice. But I wanted to go back. You, in your background, mentioned, innovation and tech, that thread throughout the positions that you've held. So I heard you talk a little bit about technology infused into the financial modeling, but I was curious if there's any tech or innovation you could share around whether it's, user experience, sort of what investors might be empowered to do through managing their assets on your platform, or any other type of infusions of tech for the actual benefit of the investor.
Great question.
That you guys might be considering.
Yeah, right now, because it's sold as a mutual fund, the client experience is typically between the dealer, whether that's an online brokerage or an advisor someone works with, or the LifeWorks platform for someone who manages this as part of their workplace savings program. So that experience is today controlled there. We have bold ambitions to play in different parts of this. But what I can tell you is our website, retirewithlongevity.com, has two calculators there. Visualize, one's a simple visualizer of the income someone can expect. The other's a bit more of a picture of a Canadian retired investor's income profile. When I look and I see calculators, that exist online in different places, often they're very complex. I think they may be in some cases designed to make the person showing it to the client look smart, or it's more about showing complexity than simplicity, and we want to lead with that. I mean, our investors are very intelligent, but this is not they're not actuaries, they're not financial, PhDs, and so the more you can show someone simplicity, I think, and so we've got some calculators today. Where I can see us going with this is, too often we go to averages. Planners often say, well, the average person who's 65 can expect to live to be 87, 88, depending on country and gender and so forth. So let's build you a plan to 90, right? But averages are always dangerous. I go back to that fable, would would you walk across a fast flowing river if I told you on average it was only 2 feet deep? Well, if it's 8 feet deep in the middle, you'll get washed away. And I think the same thing is exactly what exists for investors. So I could see us in the next year building tools that make Monte Carlo simulations readily accessible in a real way to investors. And I think Monte Carlo is a thing, and stochastic, fancy, Greek word or Latin word for it. These are terms that just sound like a lot of sophistication went in on the back end. But I'd love to show investors that there's a wide range of possibilities, and what you need to do is optimize. You need to optimize your situation regardless of what happens, right? It's what we do when we insure things. It's what an annuity does, right? And annuities are great products. But that idea, it's not easy, and these things are complex in the back end. How do you turn it into something that's visually quite simple? I think my experience at Facebook for a couple of years, is a great example of a platform that takes, the amount of information flowing through that. Whether you think about our user experience and being able to, to attend events and see that our friends are going, that is a tremendous amount of information that's simplified in a really consumable way by people of all ages. It's become a controversial platform. Social media itself is a controversial topic these days. But likewise, if you think about what happens, I was on the ads team at Facebook. If you think about what happens there, the amount of data that is going into determining that I see an ad, advertising a certain car brand or, sneakers that they want me to buy. It's immense amounts of information going in. So that's where I see a lot of education that's really helpful to investors. I think our legacy should be, we'd love to really help investors in Canada and around the world understand the challenge of decumulation, if that's what we create, however they choose to solve that, great. And I think our fund will ride that wave, of course. But I think it's just so important to us that people are suffering, and lots of investors are doing really well. But we hear from Canadians every day who are really hit by what's going on in markets, and they've not got enough money to last them forever at their current rate of spend. And so being able to articulate that is where I'd love to contribute.
Okay, so your fund versus annuities, does your product replace annuities if I'm an investor, or does it complement it? Would I ever own your fund and have an annuity at the same time?
Yeah, many of our investors do. And when we speak with them, we do market research and talk to our investors. We welcome them to the community we're building. And a surprising number of them do say, I have annuities and I heard about this fund and I understood the differences. I like the shelf analogy, and you think about, a shelf at a store and the two products side by side on the shelf, they each have different trade-offs and benefits. And I think that's very true here. There are investors who will look at our fund and say, no, what I'm actually after is an annuity. I need that guarantee. I'm willing to accept less. What I say about guarantees, we've got a blog post on our website about guarantees. They're wonderful, but they come at a cost. And you may or may not choose to take that cost. I mean, do you buy the insurance when you get a new smartphone? That means if you drop it and smash it, the company. Some people do, some people don't. They're making the right decision for themselves. I think the guarantee against market risk that comes with an annuity is right for some people and not right for others. And the research shows we've got an amazing advisory committee on this fund, one of whom, Jim Leach, ran Ontario Teachers Pension Plan, and others, Bonnie J. McDonald's a leading academic. What each of our 4 advisory committee members has told us in different ways is that investors are actually able to manage variability in income, right? Think about our lives. If I get a raise at work, I'm gonna change my spending in slight ways. It may mean more saving, but it may also mean slightly different spending patterns. Likewise, if I take a different job at a lower pay level, I'm not absolutely devastated in a irrecoverable way. We can adjust to those things. And so when you say to someone, I'll guarantee you, X percent, or I can offer you 1.5 times that as a return, but knowing that there are scenarios where it could go down to less than whatever that X was. And people rightly ask a lot of questions about that. Well, how likely is it to do these different things? And that's why we've been so transparent with our reporting, and the annual report we're putting out in a couple of weeks to show, the update on all that. But that's really how to think of it against an annuity, and that idea of compartmentalizing our income sources in retirement. Most investors in Canada do not own annuities, and I think if someone says they've looked at longevity and are going to buy an annuity, I think that's fantastic. You're protecting yourself against longevity risk. Someone says I've looked at longevity and I think I'm just going to keep my assets in a balanced fund. I think, okay, but you've left yourself self-insured effectively. And what you have to do then as an investor is decide, how do I balance the risk of running out of money at some stage, right? Which is a possibility, unless you stretch your portfolio to last until you're 115. The oldest Canadian ever lived to be 117 and a half. But I think 115 will cover, basically everyone. If you do that, you have a very high degree of certainty of underspending and leaving a lot of money to your estate. And it's great for your estate, but that's the trade-off. And so that's how we think about it.
Thanks. So, Fraser, a few times I've heard you sort of hint at, I think, a bigger why. I've heard you talk about sort of the power of the product and a little bit about the legacy of the company. So my question for you is, it feels like there's maybe an intention to shift the investor's mindset about retirement. Could you comment a little bit on kind of that bigger why, or what you hope to do in shifting people's attitudes about retirement, their attitudes around outliving their assets?
Yeah, it's a great question, Tisa. And our mantra at Purpose and on the longevity team is ambition never retires. I think we're driven by a sense of this can be an amazing third act in people's lives. People are spending more time in retirement as retirement age. It varies. We call it 65. Of course, not everyone retires at 65. We sort of use that as a cliche. But it can be such a powerful time in life. But if you're stressed about running out of money, it may not be, or it may not live up to its full potential, because, doing these things, going to see family who may live in a different province or state, pursuing hobbies, whether it's the sort of cliche of golf or some artistic endeavor, or, even giving back to your community, as like a board member or volunteer, these things, they take resources. They don't take huge amounts of assets, but they take income to be able to know that you can do these things, that you can, put gas in the car, pay the rent, et cetera. And so, that's what drives us is this idea that, there's so much research into how our society doesn't value the elderly the way that it should. And there's organizations, great advocacy organizations like CARP here in Canada, really pushing for that. But we see that as important as well, and want to be we're a financial company, we're an asset manager. We want to help people make the most out of their assets. And so that's really what drives us. But we love that saying, ambition never retires.
Yeah,
ambition never retires.
I was kind of repeating that as you were speaking. Ambition never retires.
That's great.
Yeah.
You listen, you have a great tagline, helping Canadians retire from work, not life. This is good. This is more than a mutual fund stock ticker, I think, Fraser, you've got going in your company, which is terrific. And I don't want to ask too hard. We're right up to the hour here. You focus on Canadians. How big of a lift is this to take your product and put it into the U.S.? Is it really a matter of just putting resources, or do you have to get some laws changed to do something like this in the States?
It's a great question, and we see this as applicable around the world. One of the things that I've been really pleasantly surprised by is just how many people around the world are all working towards the same goal here of giving people security in retirement. And I think there's applicability of this in the U.S. as well as other countries. Places in Europe are going through transitions with their pension structure. Australia has built an incredible pension system, but it's been really focused on accumulation and not as much yet on decumulation. Laws changed, I would say, is too strong a wording. It's what we needed here in Canada was to work with our regulators to have some exemptions to the way, the rules and guidelines that cover mutual funds. This idea of a fund that redeems at less than NAV, its current value, it raises eyebrows. And we needed to show the regulators, first, that this was an important problem we're solving, that we were doing this for reasons that to give us exemptive relief on that issue allowed us to create a really powerful product. And that process took a couple of years. But as soon as they understood the problem and understood that our structure and the transparency and how we would use it was powerful, they became not only open to it, but actually champions and ambassadors for us around the country, which was great. In the U.S., I think similar things would need to be true. And, you have regulators who take a really strong investor protection focus, as they should, and as ours do here. And, we're looking to opportunities to bring this to the U.S. and other markets. But it really has to fit within every country's, the structure around how they manage investment funds. And, we're so proud of what we've built in Canada, and to see the traction it's getting, to be on an institutional record keeping platform this early in its existence, I think is really, really powerful. And the press we've gotten around the world has been incredibly encouraging and wonderful. So yeah, stay tuned on the US. We'd love to we'd love to bring a similar product to the US, and it's choice for investors, right? And as I say, annuities are great, but the guarantees come at a cost. That's right for some investors and not right for others. And I think this belongs on the shelf beside products like that.
Excellent. All right. Listen, Fraser, thanks so much for your time. Tisa, thank you.
Thank you. Thanks, Paul. Thanks, Fraser.
And listen, Fraser, we'll put your website in the show notes. Any other places people should go to learn more about your company and the product, or reach you?
I think the website's great. The contact information is there for anyone interested. Reach out, and our team will get notes to me as appropriate. Purposeinvest.com is the parent company's website if people are interested in purpose. But retirewithlongevity.com is really a great resource with lots of articles and helpful tools.
All right, good. All right, hey, thanks so much. Thanks to our listeners, and join us again next week for another episode of That Annuity Show.
All right. Thanks for having me.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.